Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we would come to you today with a brief market update, kind of let you know what's going on out there. A little bit of sort of Mr. Toad's wild ride here in the month of March. S&P 500 right at about 55.11. That is down 6% year to date. And basically, we're kind of opening up the day here today right about at the level that we were back at March 13th. So in the span of about 15 days, the market ran up by about 3% and then gave it all back. And we're back where we were about 2 weeks ago. And this highlights one of the things that'll be a little bit of a theme of this market update, but it highlights the kind of difficulty of trying to time this market. The market is definitely in a sort of fear-based, risk-off, uncertainty environment. And the interesting thing about those 10 types of markets are that they tend to be very volatile because minor changes in sentiment can quickly flip the market into either risk on or risk off, depending on how that sentiment changes. So let's talk a little bit about what's driving that sentiment. We do have the fear middle of this week of additional tariffs going into place. April 2nd is the date that's been named by the administration as the date in which a lot of reciprocal tariffs are going to go into place across a broad swath of our trading partners. There's a lot of uncertainty still about what that looks like because there hasn't been a lot of clarity out of the administration on what those tariffs look like. They seem to shift and change every day or every week. And that just creates a lot of nervousness out there. And then at the same time, you have these sort of broad macro indicators that are also a little bit challenging. So inflation still remaining somewhat stubbornly high, consumer sentiment numbers looking, very, very low as people are just in sort of a anxious phase. And the one thing that I would just remind everyone is that humans hate uncertainty. The markets hate uncertainty. In some ways, uncertainty is actually worse than the actual news itself. We've seen this a number of times play out through history. You can see it. I won't bother to give you a list of all the different historical examples of oil prices or market prices or whatever else. But frequently, when we're unclear about what the outcome may be, that anxiousness or nervousness or worry is actually worse for us than knowing what the outcome is, even if it's a bad outcome. And that's generating a lot of sort of risk off in the marketplace, a lot of feelings of, hey, maybe I should just lock in some gains or run to safety, et cetera. And I will just tell you, that's not a great way to play the market. Trying to time this is exceedingly difficult. Particularly since the market does seem to move on those sentiment, indicators and gauges. We really encourage. It's a very volatile time, as can be evidenced by the fact in 2 weeks you saw a 3% rise in the market followed by a 3% drop. Minor shifts in sentiment can really drive the market higher or lower. And we really, really encourage you, trying to time this market is more actually trying to predict sentiment than it is trying to predict the actual economic data that's coming through. And predicting sentiment is very hard. So once again, we encourage you not to try and do it. We would also just remind you that diversification is your friend in this type of market. If we just go through and look at all the different asset classes, the S&P 500 is down about 6% year to date. The Mag 7 is down about 17% year to date. And interestingly enough, if you do the math on that, since the Mag 7 is somewhere around 30% of the overall S&P 500, the drop in the Mag 7 is actually accounted for the vast majority of the drop in the S&P 500, believe it or not. If you start to look at other asset classes, whether it's bonds, those are up about 2.2% 2% year to date, sort of exactly doing what we'd expect, rallying in times of fear. International stocks, as we talked about before, up about 5.7% year to date. Small caps down about 10.4%. That's a little worse than the overall market, but still not as bad as that Mag 7 that we noted. And so we just note that if you have sort of a broadly diversified portfolio that includes international stocks, that includes fixed income in your portfolio, et cetera, then some of the headline numbers that you're seeing come through really aren't as bad as what you should be seeing within your portfolio. With that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. Hope you're having a great day, and I look forward to talking to you again soon.